Hello everyone, in yesterday's session we saw the format of journal and today we will be discussing how to prepare journal. Okay, now first let us see steps in journalizing. Before recording a journal entry, it is essential to analyze a transaction in order to determine the two accounts which are affected. Means after reading each and every transaction, first you have to find out what are the two different types of accounts which will be affected by that transaction. Then on the basis of rules of journalizing, remember in one session we have done traditional approach, and so we saw personal account, real account and nominal account and their rules. So we have to follow those rules, and we based on those rules we have to see which account will be debited and which account will be credited. Now after finding out these things, what we have to do is that we have to make proper entry in the journal, and while writing there are certain rules that we have to keep in mind. The first one is it is not necessary to use the word account or AC after the personal accounts, as we know that personal accounts are nothing but natural human beings or any other business organization's name. Okay, so in front of those accounts we don't have to write AC or account. Then after every journal entry, a line should be drawn in particulars column so that each entry is separated from the preceding one. Means, see, when we look at the format of a journal, here we will write, we will make the entry, and after making entry we have to draw a straight line in particular section only, just to differentiate each transaction. Okay, then now let us see the next step. At the end of each page, means suppose you have started preparing journal, okay, and your question is still there but you have finished one page. So what you will do is that you will find out total of both debit and credit columns. Both will be equal because the amount that we enter in debit and credit side are usually same. So these totals are carried forward to the next page progressively up to the end of the accounting period. Means until unless the questions finishes we have to keep on doing that. Means after finishing each and every page we have to find out total, and for this purpose the words carry forward or CF are written in particulars column at the end of each page. Means suppose this is your page and you have started preparing journal, and at the end of the journal you will have to find out total of debit and credit column in here, and here you have to write CF, that means carry forward, and that total amount you have to write in the next page at the top head of your new page, and that you have to write PF, that is brought forward. Now let us see what are the rules of journalizing. It means we have to go through, it will be like a revision for traditional approach. Now first type of account is personal accounts, and rule for that is debit the receiver and credit the giver. So first let us see debit the receiver's rule. Suppose here one example is given. If we give 20,000 to Gopal, means Gopal he is receiving this 20,000, so Gopal's account will be debited. Means we will write Gopal debit to cash, but for this example you just focus on Gopal's account. Since he is the receiver of amount, his account will be debited, and since this is personal account, no need to write ACCOUNT account or AC in front of Gopal's name. Now the second part of this rule is credit the giver, and in this part example is given. If we received 50,000 from Govind, means we received cash, and who is the giver? Govind. So his Govind's account will be credited. Means we will write to Govind 50,000. Now this was the rule for personal account. Now let us see real accounts rule. According to the rule of debit what comes in and credit what goes out, the account of the cash or other property which is received by the business firm is debited, and in the same way the account of the cash or other property which goes out of the business is credited. Now let us take one example. In while we were discussing about this traditional approach and modern approach, we saw that all the assets except for bank and debtors account, all other assets accounts are nothing but real account. So when we take example of machinery, okay, it is one of our asset, and if we purchase machinery, that means it is coming inside our business. So what, according to the rule of real accounts, debit what comes in. Since machine is coming inside the business, we will write machinery account in the debit one. And since this is not a personal account, we have to write AC in front of machinery, okay, and debit 5 lakh rupees. But while purchasing that machine, we are paying cash, means cash is going out from the business, and we know that cash account is also a real account. So according to the rule of real accounts, credit what goes out. That means machinery account we have debited and cash is going out from the business, so we will write to cash account. That means cash is going out from the business, rupees 5 lakh. Now I hope till here you have understood properly, and if not, then you can rewind the video and see again, because these are the basics of accountancy. These rules of personal account, real account and nominal account you have to remember all the time. Okay, then last type of account is nominal account, and nominal accounts rule was debit all expenses and credit all incomes. Now first let us see the first part of this rule, debit all expenses. Now example, if 20,000 are paid for salary, salary is also a nominal account because it is an expense account. Okay, so since it is expense, we have to debit it, so we will write here debit column in debit row, salary account debit 20,000, and cash, since cash is our real account, while paying salary cash is going out from the business, so according to the rule of real account we credited cash account rupees 20,000. And second part of nominal accounts rule is credit all incomes, means whatever income we are getting, we have to credit those things. Okay, now example is given, if 5,000 are received for commission. Now when we receive commission of rupees 5,000, it means that cash is coming inside the business, so cash is real account, and real accounts rule is debit what comes in. So while receiving commission, cash is coming inside the business, so we debited cash account debit, and according what we are receiving is commission, and commission account is a nominal account, and according to the nominal account credit all incomes. Since this commission we are receiving, it is our income, so we will write on the credit side as to commission account 5,000. See, for each and every transaction, minimum two accounts will be affected, and either one account will be debited, one account will be credited. And even though both the accounts are not of same types of account, either one can be personal, one can be nominal, but ultimately according to their rules, both of the accounts, one of them will be debited and one of them will be credited. It will not happen like this, that both the account will be debited and both the account will be credited. Okay, so you have to be careful. First, what you have to do is that you have to read the transaction carefully, you have to identify the two types of accounts involved, and then you have to identify what types of accounts are those two, whether they are personal account, real account or nominal account. And if they are, after finding out what type of account they are, you have to remember the rules for making entry, means which account will be debited and which account will be credited. Now let us see meaning of goods. In business, when we talk about goods is nothing but those things which we purchase for resale. In other words, goods are the commodities in which the business deals. For example, if a cloth merchant purchases cloth, the cloth will be termed as purchases. Okay, it is his goods that he is going to resell in future, so for purchasing that cloth it will be termed as purchases. But if the same cloth merchant purchases some furniture, say chairs and a sofa set for sitting of customers, the furniture so purchased will not be termed as purchases, because he is not going to resell them, he is going to use it in the business. So in that case we will write furniture account. Okay, In this case, furniture account will be debited instead of purchases account. Remember that purchases account is used only when we purchase goods that we are going to resell in our business. It means that purchases of assets are not termed as assets in accounting terminology because these assets are not meant for sale. Now, goods account, they are classified into 5 accounts in journal entries. Now let us see what are those accounts. First is purchases account. When goods are purchased, instead of debiting goods account, we will not write goods account, but we will write purchase account. Purchase account, it is a nominal account, and while passing a journal entry, purchase account should always be debited because the rule of debit all expenses and losses means purchases is a nominal account, and nominal accounts rule is debit all expenses. And while purchasing goods, we used to make payment, so it is an expenses, so we will debit the purchases account. Then sales account, it is totally opposite of purchases account. While selling goods, it is our income, and according to the nominal accounts rule, credit all incomes and gains. And instead of writing goods account, we write sales account. Okay, when we purchase goods, purchases account is involved and it is always debited. While selling goods, sales account is involved and it is always credited. Remember that. Then third type of account is purchases return account. This account is also named as return outward, means another name of purchases return account is return outward, because when we return something after purchasing, it is going outside of our business, so it will help you in remembering return outward name. It is also a nominal account and should always be credited. Remember, purchases account is always debited and opposite of purchase is purchases return, so it is always credited. Then sales return is opposite of sales account, and sales account is always credited, so sales return account will always be debited. And sales returns, another name is return inward, because after selling goods, if the customer returns something to us, then it is coming inside the business, so we will write return inward. And there is another type of account, that is stock account. Now there are some important considerations, or you can say that rules that you have to keep in mind. Sometimes people, they used to get confused while passing journal entries. Okay, so pay very much pay attention in this one carefully. Now in the transactions relating to the purchase of or sale of goods, it has to be decided whether a transaction is for cash or for credit, means either a transaction can be cash or credit. So first we have to find out what kind of transaction is that. Is it a cash transaction or credit transaction? And after finding that out, we have to make the journal entries. Now for finding out whether the transaction is cash or credit, we have to keep some rules in our mind. Suppose if in the transaction relating to purchase or sale of goods, the name of purchaser or seller is not given, it is considered as a cash transaction. Remember, while purchasing or selling, if the name of the purchaser or seller is not given, then it means it is a cash transaction. Example, goods sold for rupees 50,000. In here, name of the seller is not mentioned, then automatically we have to assume that this transaction is a cash transaction. Then second, if in the transaction relating to purchase or sale of goods, the name of purchaser or seller is given along with cash, it is considered as a cash transaction. Example, goods sold to Gopal for cash. In this example, name of the seller purchaser is given along with, they particularly mentioned that they sold for cash. That means obviously it is a cash transaction. Then third is, if in the transaction relating to purchase or sale of goods, the name of purchaser or seller is given and it is not stated whether it is a cash or credit transaction, it is considered to be a credit transaction. Now in this example they have only mentioned goods sold to Gopal, they haven't mentioned for cash, for credit, anything. So automatically we have to consider that this transaction is a credit transaction. Okay, so the three rules that you have to keep in mind is that if the name of the seller or buyer is not given, then you have to consider it as a cash transaction. If the name of the seller or purchaser is given along with the term for cash, that means it is a cash transaction. And if only the name of the seller or purchaser is given and if they have not mentioned whether it is a cash transaction or credit transaction, then you have to understand that it is a credit transaction. Now in case of some expenses, even if the name of party receiving or payment or making payment is given, it is still considered as a cash transaction. But it is totally different in case of expenses. In expenses, if the name of the receiver or the payer is only given, but still we have to consider it as a cash transaction. Earlier in case of goods, we used to think if only the name is given, then it will be a credit transaction. But in case of expenses, even though they do not mention that salary paid to Mukesh in cash or something, but if the name of the receiver or the payer is given, then it will be a cash transaction. So these are some rules that we have to keep in mind. So after watching today's session, what you do is that you go through the rules of traditional approach, you by heart those rules, you practice among yourself, means you read some transaction and you try to find out what are the different types of accounts involved on those transactions. And from our next session we will start practical questions of journal. And if you have any doubts or any queries, you can contact me. Thank you.